In 2022, homeowners were holding a record high of $27.3 trillion in equity, but many people simply have a very little idea on how to tap into it. So, if you are one of those homeowners with a significant amount of equity, in today's video, I'm going to be talking about everything you need to know about taking out a home equity line of credit. HELOCs are probably one of the most common ways of having a mortgage that allows you to tap into the equity of your home, but a lot of people simply don't understand them. So, in today's video, we're going to go over the ins and outs and everything you need to know from how it works to how to use it, some examples, the whole process, and how to make the most of your HELOC, as well as some alternatives. And we're also going to be reviewing some expected interest rates as of me recording this video. All right, so first and foremost, let's talk a little bit about how a home equity line of credit works and what it is. Now, a home equity line of credit is a revolving credit loan that uses equity in your home as collateral. If you already have a first mortgage on your home, so an existing mortgage, a home equity line of credit is going to be a second mortgage or a second lien. If you have your home paid off free and clear, then this is going to be your first lien position mortgage. So just something to think about, guys. If you already have a mortgage, having a home equity line of credit is not going to change any of the terms of your existing first mortgage. So you get to keep the same interest rates, you get to keep the same terms that you already have. This is a completely second different loan. So something that you definitely need to understand. So a HELOC allows you to borrow up to a certain amount of your equity, and that's usually going to be determined by the following factors. The first one is going to be your home value. You need to have equity in your home to get a HELOC. The second one is going to be the current liens on the property, if you have any. Third, there's going to be your income. You do need to have income in order to qualify, whether that is by having salary income, self-employment income, or if you are retired. So you do have to show some sort of proof of income in order to be able to pay back the line. And finally, credit scores and the credit liabilities that will show up on your credit report. So obviously things like student loans, personal loans, other mortgages, of course, will change how much home equity line of credit you can qualify for. Now, remember what I said about the revolving part. Let's talk a little bit about that so you know exactly what that means. A HELOC really works like a combination between a checking account and a credit card. And just like how credit cards work, you borrow what you need and only pay back the interest on what was withdrawn. So, say for example, you have a credit card through American Express and your limit is $10,000 as your whole entire line with American Express, but you only use 2,000. So you only pay back the 2,000 that you owe. The same thing works with home equity lines of credit. So you only pay back whatever you use. At the same time, it's going to work a little bit like a checking account because when you get a HELOC, you also get a checkbook and a debit card. So you can literally write checks from it and go to an ATM and get cash as you would a regular checking account or savings account. And these are really some of the reasons why HELOC has a lot of flexibility, because literally you can use it for whatever you want, whenever you want. You have absolutely nothing to stop you from using it whenever, and you pay back what you owe. So now that you know exactly how that works, let's talk a little bit about the payments, how they work, and what kind of terms you can typically get with a HELOC. So normally HELOCs only require an interest-only minimum payment, meaning that if you only make your minimum payment each month, your balance will never go down because the minimum payment is interest only. Therefore, you'll be paying the interest on the full amount you borrow until you make a larger payment towards the principal or the whole entire line of credit that you owe in full. So HELOCs normally have a what we call a 10-year draw period and a 20-year repayment period or 30-year repayment period. Every lender kind of works a little bit different. So you want to check out with whatever lender and see what basically they offer you. But kind of what this means is that you have 10 years to use the line, but after the 10th year, the lender will close the line and require you to pay whatever balance you have after the 10th year on a fully amortized payment spread over the next 10 to 20 years. So just to kind of give you an example, if you are on the draw period or at the end of it and you owe, say, $60,000 at an interest rate of 9%, your interest only payment would be $450 a month. But if you enter that repayment period, the payment will jump up to $760 a month if you have a HELOC for 20 years, because now at that point, the lender will want to have the whole $60,000 be paid in full by the end of your HELOC, the life of your home equity line of credit, basically. And also, just so that you guys know, the most common types of HELOCs are those that carry a variable interest rate. And just like literally almost any bank or lender that offers HELOCs will most likely only offer the variable rate one, almost. And I'm going to tell you why, and I'm going to give you maybe some other ones that may be available. But why is that? Because again, kind of like I said before, a HELOC is a revolving line. It's a line of credit. And just like your credit cards, those are also revolving lines, and they also have a variable interest rate. And since we're talking about variable interest rates, you should also know how variable these rates can be. And this is where the prime rate comes into play. And this is why you should understand what the prime rate is and how it works. So, the prime rate is the interest rate that banks charge their most credit-worthy customers. It basically serves as a benchmark for many other interest rates, and that includes HELOCs, but that also includes things like your credit cards, like your personal loans, like your student loans and other consumer lending products. Now, the prime rate typically is influenced by the federal funds rate, which is set by the Federal Reserve, and it can fluctuate over time. And right now it's been sort of going higher and higher, seems like, because we're going through the worst inflation over the last 40 years. The Fed has been increasing the Fed funds rate in order to slow down investing and borrowing. And you probably have seen it yourself that rates are much higher than what they've been in the last 10 years. In fact, the Fed has raised interest rates 10 times in a row since March of 2022. But this doesn't mean that every HELOC is a variable rate one. For example, you might find a bank or a lender that might offer something unique. For example, there are 3-year HELOCs available in where basically you literally have just 3 years to use it, and then you get a lower interest rate. And there are banks that may offer something with an introductory period, like maybe a 6-month fixed rate, and then the rate changes, it becomes variable, or maybe something like a low interest rate for the first 6 to 12 months, and then it becomes variable. So something like that. So every bank or lender credit union can do something a little bit different. You're just going to have to see what makes the most sense for you. But anyways, there are also straight fixed interest rate HELOCs. So just like your regular 30-year mortgage, 30-year fixed mortgage, there are 30-year fixed interest HELOCs. But honestly, I really wouldn't recommend those because the rates are going to be substantially higher than the variable rate ones. So when it comes to getting a HELOC, you kind of have to get comfortable about the variable rate situation because, again, most of them are going to be like that. They've always been the same way. Now, I wouldn't necessarily be too concerned if I were you because you can always take advantage of, say, if the interest rates go down, you can always get another HELOC and pay the one that you already have with the higher interest rate. So sort of like a refinance, except that it's not really called a refinance. You're just basically taking out another line of credit to pay off the one that you have. So you can do that if the rates go down at some point in the future. But even if they don't, just understand that obviously you do have that interest only payment. So even if the rates do go up, your monthly payments should not be going up too much. All right. Now that you finally understand all of this stuff, we do have to talk a little bit about the margin because this is important when it comes to figuring out what interest rates you're going to end up with, wherever you end up going with your home equity line of credit. So the margin is basically, just to make it simple to understand, is really how much the bank is going to make off of your HELOC. So when you apply for a HELOC, the lender will add a margin to the prime rate to determine your final interest rate. So the margin is literally a fixed percentage that's added to that prime rate, which is going to vary from lender to lender. And so, for example, if the prime rate today is 5.5%, which is today 5.5%, and the lender's margin is 4%, then your interest rate would be 9.5%. Now, you definitely need to know that if you have a really good credit score, your margin might be a little bit lower than somebody who has a lower credit score. So this is why it's important to have a really good credit score when it comes to pretty much applying for anything. But just so you know, your credit score can influence how much that margin is going to be. For somebody that has lower credit scores, the lender will obviously want to have a much bigger margin because you are a riskier borrower, just like anything else. So that's really kind of how the margin works, how the prime rate works, and that's how you get to the interest rates on HELOCs. Now that you know that, let's talk a little bit more about advantages and disadvantages of getting one. And the main advantage of using a HELOC is that you can borrow large sums of money very quickly and very easily with relatively low interest rates, at least much lower than using a personal loan or even your very low interest rate credit cards, which kind of nowadays they don't simply exist. But this makes them really, a pretty attractive option for financing major purchases. For example, if you're looking to purchase another home, an investment property, or a vacation home, or maybe you're looking to buy a home in the future that you're going to be moving into, having a HELOC allows you to do that because you can tap into the equity of your home to use it for a down payment on something else, or to buy a house in cash if you have a lot of money into your equity. Or maybe you want to do home improvements. So, home improvements cost a lot of money. So having a HELOC allows you to have this flexibility of having access to a lot of your equity in order to fund home improvement projects. Now, on the other hand, you're obviously going to have some drawbacks. And one of them is very obvious, and is that you can get into debt very easy if you're not careful. Because one, you do have access to this big sum of money. And if you only made those minimum payments each month, your balance is never going to go down, meaning that you're going to be paying interest on the full amount that you borrow until you make a larger payment or you pay off the loan in full. A lot of times people can find themselves in a situation where they get attracted to the low payments, and 5-7 years go by and they have not paid a single penny towards principal. So the payment will go up substantially. Additionally, if you fail to make a payment on time, your home could be at risk of foreclosure. This is, at the end of the day, another mortgage. So just like as if you were missing payments on a first mortgage, if you miss payments on a second mortgage, the lender can take your home. So definitely important to know. This is something that you need to consider before you take out a home equity line of credit. Now that you understand all of these things, I'm going to show you how to apply for one, kind of what are some of the things that most lenders and banks are looking for when giving you a home equity line of credit. So essentially, this is what you're going to need. One is going to be your credit history. So most lenders are going to require a good credit history before they approve your application. I found that most lenders will want to see a credit score of at least 680. Yes, I've heard before that you can get a HELOC with a low credit score as low as a 640. But quite frankly, I will never get a HELOC with that low of a credit score unless I have a considerable amount of equity in my home, probably a loan to value of no more than 50%, just to kind of offset that low interest rate, the low credit score. But even then, a lot of banks would just not even offer you one of these products with a credit score under 680. And some banks can be even more strict, maybe not even under 720 or 740. The second thing, obviously, is equity. It goes without saying that you need to have equity in your home in a pretty good amount of it. But in most cases, you can get up to 90% combined loan to value on how much equity you can get. And I'm going to explain about kind of what that means later. The third thing is going to be income documentation. And every lender that does a HELOC will require documentation of your income and other financial information, just basically determine how much you can borrow. I've gotten questions before of like self-employed people that may not have the income on taxes, and they wonder if maybe they can use bank statements to get a HELOC. Well, unfortunately, the answer is no. Most lenders in banks will want to see taxes for somebody who's self-employed, or obviously if you have just straight salary, then you use that to qualify. But these programs do require basically all of the documents that you will need in order to purchase a home or refinance an existing mortgage. All right, so now that you understand everything about it, let's go ahead and talk a little bit how interest rates work. And I'm sure a lot of you guys wanted me to get to this point. So what can you expect as far as rates go right now? And I am shooting this video on July 2023. So right now, the prime rate is at 8.25%, and interest rates for HELOCs range as low as 8.25% for the most well qualified borrowers, meaning somebody that has a loan to value of, say, 70%. So they don't owe more than 70% of the value of their homes, and also have a credit score of 780 plus. So I went ahead and checked out 5 different banks around the country, and this is what I was able to find. First one is Bank of America, right now having an introductory rate of 7.2% for the first 6 months, and then 9.24% afterwards. Second one, Truist Bank. They are very popular with HELOCs. They have a prime plus 0.25%, or currently at 9.125%, to as high as 16%. So as you guys can see, that's a pretty big spread. The 16% would be offered to those with lower credit scores. Third one, US Bank, starts at 8.25%. And finally, Navy Federal Credit Union, rates start at 8.5% for the prime borrower and up to 18% for those that have lower credit scores. And finally, here's a little bit about closing costs. Now, there are always closing costs when you're getting any type of mortgage, and HELOCs are really no different. Closing costs typically include fees for document prep, title searches, appraisal services, etc. And these can range anywhere between 1% to 2% of the loan value, depending on your lender. And typically that's going to be included into the line amount. So not necessarily that you have to pay it out of pocket, but just so you know, they are going to be there. Maybe the only thing that you do have to pay out of pocket would be like an appraisal, which can be anywhere between $200 to, say, $600 or something like that. You know, make sure that you talk to whoever your bank is going to be about getting your HELOC, and just find out what some of those closing costs are going to be. But just so you know, just there's a big difference between a HELOC and a regular refinance, is that HELOCs normally do carry lower closing costs. All right, guys, that's basically it. Hopefully through this video, you understand fully what a HELOC is, how it works, the interest rates, the closing costs, some of the advantages and disadvantages. So hopefully you like this video. If you did, make sure that you give it a thumbs up, like this video, and I will see you on the next one very shortly. Thank you for watching.